Welcome back to the deep dive, everyone in collective. Today we're zeroing in on something really fundamental in the startup world, something many of you might, run into. That's convertible notes, whether you're building a company or thinking about early investments.
Exactly. Think of this as the inside track.
Yeah, we're going to break down what they are, how they actually work.
The good, the bad,
Right.
the benefits and the limitations for startups, especially relevant for the collective community.
And we'll hit those key terms too: valuation caps, discounts, interest, maturity dates, all that stuff.
We will. And also touch on how they interact with the cap table, which is always important, and their role in bridging funding rounds.
Okay, great. So let's just jump right in. What is a convertible note, basically?
Okay, so put simply, a convertible note is debt, but it's debt that can change into equity, into shares in the company down the line.
Right, so not immediately equity.
Not immediately. It usually happens when the company raises its next proper funding round, like a Series A. That's the typical trigger.
So it's kind of like saying, I'll get my shares later. Is that a fair way to put it?
That's a pretty good analogy, yeah. It's like an IOU for future shares. An investor puts capital in now and gets a promise of equity later, usually when the company's value is a bit clearer, figured out in that next funding round.
Okay.
It's really common. You see it all the time with early stage companies, the kind many collective members are involved with. It gets that first crucial bit of cash in the door.
Right, that makes sense. But why do it this way? Why not just figure out the price and sell shares straight away? What are the upsides of using these notes?
Well, there are some pretty strong reasons. One of the biggest, simplicity.
Simplicity.
Yeah, the terms are generally shorter and simpler compared to doing a full equity round right at the start. The legal docs aren't as hefty.
Less paperwork, less lawyer time.
Exactly. Saves time, saves money. You might have heard of SAFE in the U.S., simple agreements for future equity.
Yeah, I've seen those mentioned.
They're kind of a cousin to convertible notes, even more standardized. Technically not debt, but the same idea, simpler, faster agreement for equity later.
Okay, simpler, faster. That definitely sounds good for a startup that needs to move quickly. What else?
Another huge one, and this is really key for early founders and collective. It lets you postpone the valuation argument.
The what's my company worth question.
Precisely. When you're super early, maybe pre-revenue, valuing the company is, it's tough. It can feel like guesswork, and founders and investors might be miles apart.
Yeah, I can see that causing friction.
It can. So convertible notes let you sort of kick that can down the road. You agree to figure out the value later, usually based on what the next round investors think it's worth. It aligns everyone better early on.
Okay, so you avoid that tricky negotiation right at the start. Smart. Any other advantages?
Well, tied to that, the whole negotiation process for the note itself is usually quicker. Fewer big terms to haggle over compared to a priced equity round.
Meaning you get the money faster.
Generally, yes. Faster funding, lower legal bills. For anyone in collective focused on just getting things built, that speed is golden.
Time is money, especially then. Anything else?
One more important point. Usually, in the tech startup world anyway, these notes are unsecured.
Unsecured, meaning?
Meaning if the worst happens and the company fails and can't pay the money back, the investors generally don't have a claim on the company's assets, like its computers or IP.
Okay, so a bit less risk for the founders if things go south.
It can offer some protection, yeah, in that very risky early phase.
All right, so we've got simpler terms, avoiding the early valuation fight, faster cash, and usually unsecured. Seems like a really useful tool. So let's get into the specifics now, the mechanics. What are the key bits of these notes that collective members really need to understand?
Okay, yeah, the components. There are a few critical ones. Let's start with the valuation cap. This is a big one.
Valuation cap.
Right. So this sets a maximum valuation for the purpose of converting the note into shares later on. It's a way to reward those early investors if the company's value really takes off.
Can you give us an example? Make it concrete.
Sure. Let's say an investor puts in money via a note with a £5 million valuation cap.
Okay.
Then the company goes on to raise its Series A, and the new investors value the company at, say, $15 million.
Right, much higher.
Much higher. But because of that £5 million, the early note investors get to convert their investment as if the company was only valued at £5 million.
So they get shares at a much lower effective price.
Exactly. Way more shares than if they converted at the $15 million price. It's like a built-in bonus for getting in early, especially if the valuation jumps significantly past that cap.
Got it. So it rewards the early risk. Makes sense. What's another key term?
Closely related is the discount, or sometimes it's used instead of a cap or alongside it.
A discount, okay.
This gives the note holders a percentage discount off the share price that the next round investors pay.
How does that work? Another example, maybe.
Yeah. Imagine a note has a 20% discount. The company raises its Series A, and the new investors buy shares at, let's say, €5 per share.
Yeah.
The note holders, with that 20% discount, they convert their investment into shares at 4 each, 5 minus 20%.
So again, they get more shares for their original investment than the Series A investors do.
Precisely. It's another mechanism to give those early backers a better deal for taking the initial risk.
Makes sense. Now, you said these start as debt. What about interest? Do they earn interest like a loan?
They often do, yes. Since it starts as debt, interest usually accrues on the principal amount.
And what sort of rates are typical?
It varies, but the UK government's future fund, for instance, set a benchmark of 8%. It's not usually paid out in cash, though.
No. So how does it work?
Typically, that accrued interest just gets added to the principal amount, and the whole lot converts into more shares when the conversion happens.
So the initial investment effectively grows a bit before it turns into equity.
Exactly. A little kicker before conversion.
Okay. Another term I hear is maturity date. What's that about?
All right, so like any loan, these notes usually have an end date, a maturity date. This is the date by which the debt plus interest is technically supposed to be repaid if it hasn't converted yet.
But the goal isn't really repayment, is it?
No, not usually. The ideal scenario for everyone is that the company raises that next funding round, triggering conversion, before the maturity date hits.
What if that doesn't happen? If the maturity date arrives and there's no funding round? Sounds like trouble.
It definitely can be. The company would likely try to negotiate an extension with the note holders.
Extend the deadline.
Yeah, but if they can't agree or can't extend, then technically the company might be in default. They might be obligated to repay the cash.
Which an early stage startup probably can't do.
Often, no. It's very difficult. It really underlines why you need a realistic fundraising plan when you issue these notes. Common maturity periods are maybe 12 to 36 months out.
Definitely a date to keep an eye on. Now, something else. Pre-money versus post-money conversion. What's the difference there? Why should we care?
Yeah, this gets a little technical, but it's important for dilution. It's about when the value of the converting notes is factored into the company's valuation during that next round.
Yeah.
With pre-money conversion, the notes convert before the new money comes in. Their value is kind of included in the company's value before the Series A investment lands.
And post-money.
Post-money conversion means they convert after the new investment is accounted for. So the pool of shares is already bigger because of the new cash before the notes convert.
And the impacts.
Generally, post-money conversion means more dilution for the existing shareholders, including the founders. So for collective founders, understanding which one you've agreed to is pretty crucial.
Right. Definitely something to watch in the term sheet. Okay, so those are the key parts. But it can't all be upside. Are there downsides or limitations for startups using convertible notes?
Oh, for sure. There are trade-offs. While delaying the valuation talk is good early on, those valuation caps and discounts, they can sometimes mean early investors get a really, really good deal.
Too good a deal.
Potentially. If the cap is set too low or the discount is too high and the company does incredibly well, the founders and even later employees can end up significantly more diluted than they anticipated. It can sometimes even make later investors pause if the early terms look too generous.
So you might accidentally give away too much of the company very early on without realizing the full impact until later.
That's the risk, yeah. Finding the right balance in those terms is key. Another thing for collective members to consider, convertible note rounds are often smaller.
Smaller amounts of money.
Yeah, typically smaller check sizes, maybe from fewer investors compared to a full-priced equity round. Which means
shorter runway, less time before you need more cash.
Exactly. You might get the money faster initially, but you might find yourself needing to fundraise again sooner than if you'd raised a larger equity round.
Right. Smaller bites mean going back to the table more often. Makes sense. Now, how do these things fit into the big picture of ownership? The cap table, I know that's something collective folks track closely.
Yeah, very important question. So your standard cap table shows who owns equity, right? Shares. Convertible notes start as debt, so they don't sit on the main cap table as equity initially.
But they're going to convert.
Exactly, so you absolutely have to track them. Most companies use equity management software for this. You need to model what the cap table will look like after the notes convert.
To see the future impact.
Yes. For planning, for transparency with the note holders, for showing potential future investors what the ownership structure will eventually look like, you need that what-if view.
So even as debt, you treat them almost like future equity for planning purposes.
Okay.
And what actually flips that switch? What makes the conversion happen?
That's the conversion trigger. It's the specific event defined in the note agreement that says, okay, now this debt becomes equity.
And what are common triggers?
Well, like we mentioned, the maturity date can be a trigger, though usually not the preferred one. If nothing else happens, it might convert then, often using a pre-agreed formula or valuation.
But the main one.
The main one, especially for successful startups, is raising a certain amount of money in a priced equity round. The note might say, for instance, it automatically converts when the company raises, say, $5 million or more in a Series A.
So hitting a significant funding milestone is usually the key.
That's typically it. It aligns the conversion with a point where the company's hopefully made progress and achieved a more solid valuation confirmed by those new investors.
Okay, wow. We've covered a fair bit there. Hopefully that gives collective members a really solid handle on this. If we were to quickly recap the main points on convertible notes.
Absolutely. So key things to remember. They're basically debt that turns into equity, usually triggered by a future funding round.
Right.
Big advantages for early companies, many in collective. Speed, simplicity, and delaying that tricky initial valuation discussion.
But you got to understand the core bits.
Definitely. The valuation cap, the discount, the interest rate, and that maturity date. Those terms really shape the economics when the conversion happens.
And overall, they act as a really important bridge, don't they? Helping companies get from point A, that very early idea stage, to point B, where they're ready for a bigger priced equity round.
Exactly right. They might seem a bit complex at first glance, but they're a standard, vital part of this startup funding toolkit. They let companies make progress before that formal valuation.
So maybe a final thought for everyone in collective listening. As this whole early stage funding world keeps changing, which it always does, how might the way we use convertible notes or the typical terms we see, how might that shift? And what could that mean for founders and investors in our community?
Yeah, that's a great question to ponder, thinking about that balance, the speed and simplicity that they offer now versus the potential long-term impact on dilution and ownership down the road. It's constantly evolving.
Definitely food for thought. Well, thanks for taking this deep dive with us today. We hope this clears up the world of convertible notes for you.